All right, coming in.
Zoom.
Let's get started. Hello everyone, and welcome to the seventh webinar out of a series of seven, so the final one. Tonight, Pierre is going to be talking about building a solid trading plan. Over to you, Pierre.
Thank you so much, Ross. And hi, everyone. It's always a pleasure to meet you all for this final session all together. This one is a webinar 7, so session 7 already. Time flies. And we're gonna have for this special final episode, we're gonna try to combine everything we've seen so far in terms of trading tools and money management and all the skills that we have learned so far to create what we call a solid trading plan that you can repeat, on your next trades. So I am Pierre Verret, Global Asset Market Analyst at Global Markets Group, and I'm going to walk you through this. So again, feel free to ask any question you may have during the session. We'll take the necessary time to answer each and every one of you. But first off, let's move forward to the traditional risk disclaimer. So this presentation is for information only and does not constitute advice. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 53.9% of retail investor accounts lose money when trading in CFDs with this provider, and you should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. CFDs are provided by Global Markets Group Limited on an execution-only basis, and we do not provide any advice, and any written or verbal communication with us should not be considered as such. Right. So that said, let me introduce you to this session. So we're going to do something very concrete today. We've learned a lot of different training tools and theories across the last 6 sessions. But today is going to be about building a solid trading plan on a single page. Nothing too complicated, right? If you have attended to the last 6 sessions, you're not going to be lost. But anyway, this session is going to be like a recap on the first part. Is going to be like a recap of everything we've seen. And then on the second part of the webinar, we're going to see, I'm going to take like not a live example, but like an example using the MT5 platform with the chart. So you can see how professional do trades those markets. So the goal of this session is quite simple, actually. You're going to leave with a clear method, simple math to manage risk. We've seen that already. And an execution discipline you can apply on your very next trade. So we're not going to talk about magic setups or secret strategies or indicators or whatever, but about something much more powerful, a reproducible protocol step by step, so you know exactly when to enter, with what position size, and where to exit in profits and in loss. So at the end of the webinar, you will have a kind of a one-page trading plan framework that you can adapt to your own profile, right? So let's move forward. Right, so these are all the concepts we have seen so far. Let me walk you through it. It's important to go through each and every one of them in order to be able to build a solid trading plan. So basically here, I'm just going to go step by step. So on this slide, on this specific slide, sorry, you can see the 7 building blocks of a solid trading plan. We're going to go through them together because if you just respect these, you've already ahead of 90% of retail traders. So first one of the most important one, I mean, you cannot build anything without this one, is to define your investor profile. Okay, so this is even before talking about charts. So defining your investor profile, remember, it's all about, the available capital. So you need to know, with which capital you intend to trade the market with. So available capital, percentage risk per trade, trading style. This could be, very short-term scalping, intraday swing, whatever. Okay, and target markets, indices, FX, commodities, or a mix of them. Okay, so again, there are no wrong answers here. You just have to pick something that suits you. There's there's as many investor profiles as winning strategies out there, so you just need to define that yourself. You cannot pick those anywhere on the internet, or because I don't know, a trading guru told you this, you need to risk this amount, this percentage of your capital on each trade, and blah, blah, blah. No, you have to define that yourself. You need to know what kind of capital you're comfortable to trade with, what kind of, how much money you can afford to lose on each trade, and blah, blah, blah. Okay, so this is the first thing to do. So because without this, it's like going on a road trip without knowing if you've got 20 liters or a full tank. If you hear me, your plan must be aligned with your capital and your specific risk tolerance, not with your ego. Okay, we're not going to talk about emotions. And actually, this plan, all those 7 blocks we're going to talk about today, they're all there to mitigate the emotion impact on your trading. All right, so the first step is to define your investor profile. Second step is all about identify your technical setups. Again, there are no wrong answers here. You just need to define 1, 2, or 3 specific setups you want to trade with, okay, and then stick to them. Okay, so here we're talking about, I don't know, support. It's all about technicals, basically. Support, resistances, chart patterns. We talked about this. I think it was on the 3rd or 4th session. Momentum, how to identify a trend, market context, if the market is ranging, trending, volatility, news, anything. Okay, so again, you need to identify that yourself, and you need a little bit, of basic knowledge about that. All right. The idea here is to have 2 or 3 core setups, not much more than that, all right? They have to be clearly defined with objective criteria, not 15 different signals and an indicator for every color of the rainbow, if you know what I mean. So this is the second step. Third step is to set 1, 2, 3 profit targets. It could be more, all right? It could be as many as you want, but usually we do 1, 2, 3 profit targets, okay? We work with R multiples, okay? 1R equals the amount you risk on the trade. For example, if you risk, I don't know what, 100 pounds, then 2R is going to be 200 pounds, 3R is going to be 300 pounds, and so on. All right. The benefit of that is that your plan becomes scalable. Whether you have 2,000 pound accounts or 200,000 pound accounts, the logic is going to stay the same. Okay, this is very important. Fourth step is all going to be about stop losses. All right, remember we talked about that on the last session. You want to use technical stop losses. A stop loss is not 10 points because it feels right. No, it's not like that. We place it based on a structural level. It could be the last low, high, a break of structure, for example, or even a moving average or whatever. Like it has to be technical, or volatility. For example, using ATR. So now ATR is an indicator I just briefly mentioned. I don't remember in which session it was, but ATR is a volatility indicator that traders use to calculate intelligent stop losses. It's like to include the underlying volatility of the market to your stop loss. So I'm not going to go into too much detail about that today. It could be the topic of a next session. I don't know, in the future, whatever. But I just thought it could be useful to mention it briefly here. The stop must have technical meaning. All right. This is very important. I cannot stress that enough. All right. It has to be it has to have technical meaning and not just be a random number. Okay. You don't want to put your stop loss. One of the most common error retail traders do is that they enter the market with a random position size because they don't know how to calculate them. And then they adjust the stop loss according to the maximum, loss they're willing to take from that trade. And I've said that already during the last session, but we're going to do the other way around here. All right. This is how professional traders do. Fifth step is going to be about calculating position size before entering the market. So this was the very topic of the last session, actually. But for those who weren't there, maybe I'm just going to go through it a little bit again. So this is where most retail traders blow up their accounts. Frankly, they pick a size first, then force a stop to fit. We do the exact opposite here. Okay, this is what I've just said actually. First, you're going to define a max risk in pounds or euro or whatever currency you're going to be using on your trading account. Then, second step is going to be about measuring the distance from entry price to the stop. And third, you're going to deduce the position size from that. Again, don't panic. I'm going to show you how to do it. I showed it already during the last session, but I'm going to show it again during the second part of the webinar when I'm going to be showing you an example on the market. Step 6, apply exit tactics. All right, so here is going to be about using partial take profits on early targets, for example, stops that move up progressively or to break even, for example, or using, I don't know, trailing stop when the market hit a certain target, for example. So this has to be up to you. There are no magical, method or a right answer to do it. You have to define that yourself. Okay. Step 7, and this is the main logic, of this webinar. This is key to the whole method. Or how to, build an efficient trading plan. Respect the order, stop, size, entry. Okay, this is the key to avoiding emotional decisions on the market. As long as you don't know where your stop is, you don't have a valid trade, period. All right, stop first, size second, entry last. All right, so if there is no question, Ross, just let me know if you can see any questions popping on the chat. But I'm gonna switch to the platform now, and go to try
No
to show
questions at the
some.
moment. So it looks like
Okay,
everyone's good to
good.
go.
We can move forwards. So here we're going to be using like this example. Have an example on the UK 100, which is the British index, FTSE 100. We're going to be using 20,000 pound accounts, and the maximum risk per trade is going to be 0.5%. So now let me just take the platform. Okay, all good. All right, guys. So let me give you a little bit of context here. So this is the hourly chart of UK 100, FTSE 100. All right, the 100 biggest capitalization of the UK markets. All right. And so this example was taken. It was on the at the beginning of this month, actually, first week of this month. All right, and I'm very interested into this move right here. So let me give you a little bit of context. The market is rising. Okay, we have higher highs and higher lows broadly. So we can say without taking any, without taking too much risk, that the market is trading inside a bullish trend. All right, I'm just gonna keep everything simple, but to identify the trend, you need to switch, between time frames and stuff. We're just gonna stick to this one, and I'm gonna show you how building a professional and efficient trading plan. So here you can see on this chart, hourly chart, I only have 2 moving averages. All right, they're quite thin, so I hope you should be able to see them. And I'm using the RSI indicator on the lower window right here. So now look, the market is going up. Here we have a tiny correction right there. The market bounced back, and we have another bullish move, registering a new high right there. And now the market is set up for another correction. Okay, so here, because the market is rising, let's just say I'm looking to buy the market, to go long on this market. Okay. So what I'm gonna be waiting for is for the market to hit some support level and then bounce back. This is what is going to be of interest to me. All right. So now let's mark the charts. So let me do everything live. Okay. I always use support in green. Oh, maybe this is a little bit too bright. Let me choose another color right here. Okay. So we have support right there. We have another one right here. Okay. And I'm going to be looking for the market to react positively on one of these zones before considering going long. Okay. So now look, the market is inside its correction pattern. All right. We had another support area which has been broken actually right here. The market broke it And then, you know, this previous support is now acting as a resistance to the market. So it's not going to be of interest to us. I'm just going to remove it, not to overload the chart. So now we're going to wait, and you can see the moving averages have registered a bearish reversal and a bearish cross right there, confirming the you know, the corrective state, the corrective phase of the markets. So let's move the charts. Okay, corrective move right here, up, and here this is very interesting. What happens here? Okay, the markets came all the way down to that point, which is 9,647.2 level. All right, and we can see the market already registering on the first tick on this support level a bullish reaction, which is interesting for my setup to, you know, I'm willing to capitalize on a bullish trend resurgence, if I may say so. So at this point, I don't want to trade right now, okay, because the market has bounced back quite quickly in a very sharp manner. And if I enter the market right now, nothing tells me the market is not going to go back down for a double, for a second impact, for example, and that the market can still break that, you know, level or bounce back or whatever. But I don't want to enter the market too far away from a support level in that case, because I'm looking to buy, to get long on that market. All right. So I'm just going to wait. I'm going to wait. I'm going to wait for another move. And actually, what I can already do right here, I can place a trend line. All right. And as long as the market trades below that trend line, I mean, the bearish trend prevails on the short term. All right. And I can do the same actually on the RSI indicator right here, for example. Okay. Right. At this point, I'm just going to wait a little bit further. I'm going to wait for the bullish move to, you know, confirm itself and to witness some sort of clearing or breakout of this bullish trend line. So let's move forward. The market keeps rising. We can see the market is now trading between those two moving averages. And here we have something very interesting happening on the RSI. Look, do you remember, I think it was during the second module about technical analysis, we were talking about RSI and, you know, different technical indicators on oscillators such as MACD, RSI, stochastic indicators, for example. Those ones are derived from prices themselves, okay? So it's normal to retrieve the same chart patterns and trend lines. However, very often, actually, you can notice a breakout. I mean, those indicators such as RSI, MACD, stochastics, and so on, tend to anticipate the breakout. They tend to register the breakout before the actual market, before prices, right? And this is what this is exactly what happens here. We have a breakout right there. So now the RSI is still inside its selling zone. It's actually close to the neutral zone around the 50% level. But we already have a breakout, the breakout that didn't happen on the price. You can see that. The market is still trading below its own bearish trend line. All right. So this is a very good sign. This tells me that, all right, so the bounce back right there may lead to a bullish trend resurgence, which is exactly what I'm looking for here. So let's wait a little bit more. Now we have our breakout on the market, as you can see. All right. So now, look, I know some of you are going to tell me, yeah, maybe you would have earned more money if you enter the market there instead of waiting for a confirmation, because now the market has moved like, okay, we were 9,647 points, and now the market is trading close. It's almost like 100 points above that level. All right. Okay, so I mean, you're going to earn less using that method, but actually you have more probability on your side because the market has first showed you its will to go higher. It means that investors are either numerous enough or powerful enough to, you know, take the market higher to new highs, basically. So basically, you just wait for a breakout firstly announced by the RSI, then registered by the market right here. And you can see the moving averages registering a bullish reversal as well. So you're going to combine all those hints, all those clues, all those alerts, signals that are going to tell you the market is likely to go higher. All right. You don't want to enter the market on, one signal or one alert given by one single indicator. You just want to combine, you want to have like a feed, like a flow of hints going in the same direction. This is exactly what happens here. All right. So now that we have the breakout, what do we do? All right. So now we're going to define an entry level. And an interesting entry level is going to be this one. So let me take, actually, let me remove this one. It's useless. And let me take this one. So I'm going to wait for the market to retrace, to pull back a little bit in order to give me an interesting entry point, right? You want to buy the market when it's in discount, you don't want to pay a premium here, right? So here we have the markets during the breakouts that just closed above a key level. As you can see, it was the former level that the markets recognized first here as a resistance, then again here as a resistance, and then the market is registering a new high, right? And you want to wait for the market to go back to that level, okay? So it's actually more of a zone than a level. It's often like this. So let me draw it for you. Shapes. All right. So it's more something like that, actually. You want to take the wicks here into account. So now look closely. The markets went up to that point, then strong pullback right here. All right. And we already have an entry point right there on this candle. Okay. And actually, this candle itself tells you an important message. You can see that the market registered between this candle and this one, a very big, wide bullish gap. The bullish gap that has been filled almost instantly, two candles after that, right? So now we have our pullback here. And interesting fact is that the market pulled back to an interesting support level. But again, bull traders, bullish investors were powerful or numerous enough to prevent the market from breaking that point and they were powerful enough to defend that level for sure, obviously, as you can see from the chart, right? So already here you had an interesting entry point. But let's say we didn't go long on that, at that moment, because the market reacted too quickly and we didn't have the time to press the button. So at this stage, if you didn't enter the market, either you only have two options for you. Either you wait for another pullback, or if there is no other pullback, you just miss a trade and that's it. You don't want to chase the price here. Okay, never you don't want to chase the price, because nothing is going to tell you. If let's say I missed that entry level and now the market trades much higher, like 40 points higher already, and I go long right here, nothing tells you that the market is not going to go back down and you're going to be minus 40 points on your trade. So you're taking a lot of risk, entering the market here. Okay, so either you wait for another pullback, or you just miss the trade, no FOMO here, and you wait for another opportunity. The market is full of opportunity every day. All right, so don't be impatient. Let's say we have taken it, or I think there's another pullback coming. Okay, let's move forward. We can see now a bullish cross from moving averages. The RSI is now located well above the 50% level, far inside its a buying zone right now. And now we have another pullback on this candle. So with that configuration, you had two opportunities to enter that trade. So now let's say you want to enter the trade. Okay, let me pick a different color so we make the difference between the entry price and the support level. I'm going to pick orange. All right. I want to enter the market at the middle of that zone right here. All right. I don't know, 97, 40 something. All right. So now, where you have your enterprise, you have your strategy, you know that you know the market is likely to go higher. I mean, according to your analysis, you have your enterprise, which is around 9,740 points, more or less. Now you're going to start with your stop. So again, your stop has to be technical. Okay, the first technical level is the first green line here. Okay, if I mean this is not a stop level because the market can still go and touch it. This is called an invalidation level. That means that if the market can go below, all right, you know, with the volatility spike, for example. But if the market closes below that level, you may want to close the trade because, I mean, the support is no longer support for the market and your strategy, I mean, that strategy in that case didn't work out and the market is now willing to go lower, for example. But if you were to place a stop, you want to place it below, for example, for this example, because remember, you want to place the stop technically speaking. It has to be technically meaningful for you. And what's meaningful, it has to be below the green line for sure. And I want to take some caution here and place my stop. Actually, let me delete this one and place my stop below the wick of that first candle above it, right there. So I want to place it, for example, right there. It's an example. You can place it wherever you like, but it makes sense technically, okay? And you can see the market, this is very interesting because on that candle, the market not only came back to that support level, but also came back towards the 2 moving averages. So it's actually, in fact, a double support area right here, which is quite strong, technically speaking, okay? So now what's going to happen? Let me go back to what we were saying in terms of risk management. So remember that on the FTSE, on the UK 100, the value per point is £1 for one lot, for one contract. All right, it's important to know this. The entry is 9,739.4. Okay. And the stop loss is, what did I say? 9,724.3. All right. So now let me show it to you. Give me a second. Okay. So let me adjust the stop loss right there. So we said stop loss 24.3. All right. My stop loss is there. And my entry price should be 739. So yeah, inside that box. All right. So now let's say I trade with a 20,000 pounds account. All right. I don't want to risk more than 0.5% of my capital on that trade, which equals to 100 pounds. I don't want to risk more than 100 pounds. All right. So now let me show it to you. How can I do this? I need to share the whole screen. All right, let me share the whole screen. You're gonna see that because I need some specific tool right here. Hopla. All right. Okay. So now to define your position size, you're gonna take your entry price, which is 9,739.4 minus the stop loss, which is below that level. So 9,720. Oh, actually, I did a mistake. 9,739.4 minus the stop loss 9,724.3, and that gives you 15.1 points. All right. We know that for one lot, it's 1 points per point. Okay. So now you don't want to risk more than 100 points. What you're going to do is divide 100 pounds by 15.1 points. And it's going to give you 6.62. So now in order to remain cautious, you want to round that down to 6 lots. All right. So now I enter a position of 6 contracts right there. My stop loss is set. Okay. I know that if the market hits it, I'm not going to lose more than 100 pounds. So this is set. All right. I know in advance what I'm going to risk. All right. This is very important. So now that this thing has been set up and I'm in position, I've entered the markets, I've entered a long position on that market. Where do I exit? I know where to exit the trade if it goes in loss, but where do I exit the trade if it goes in gain? So an interesting resistance could be this one. Let me put it in red for you to see. Right there, at the top, actually, of that. I mean the last high actually. Shape. I'm gonna take the week into account right there, more or less. All right. This could be a nice first target. But if the market is willing to go higher, because remember, guys, I'm betting on a bullish trend resurgence. So I anticipate the market that doesn't only reach the last stop, but goes beyond that level. All right. So what we're gonna be using? A tool that we've studied before. I like Fibonacci expansion, for example. Fibonacci expansions. You're gonna do it like this. All right. So you're gonna take the first bullish swing, the whole correction, and then with Fibonacci, you can play with the Fibonacci ratios. So I don't know, 61.8% right there, which is below the last stop. You can use the 100, 123, whatever suits you, basically. So let's move forward. What does the market does? Look, the market goes higher, much higher. And yet, as you can see, the market quickly reached the first targets right there. So the first take profit has been hit. Second take profit at the 100 Fibonacci expansion has been hit as well. And actually, even a third one has been hit. The third one is 100 and I think it's, let me double check that, but it should be 123.6. Yeah, that's it, actually. It's just not labeled. All right. And then afterward, the market goes down. And actually, even at this point, you can anticipate that the market is not going to go higher. Why? Because you have some divergence here. If you take, for example, you know, all those tops are higher than the other, whereas on the RSI, oh, I didn't use the right one. On the RSI, the same tops are lower and lower, as you can see. This is called a bearish divergence. It means that the market trend is slowing down, guys. All right. And if the market is slowing down, especially when it trades close to a natural new high, for example, it means that there are chances that the market is either going to reverse or, you know, range, you know, trade laterally. All right. So that's it. That's as simple as this, right? We defined an interesting setup. We had a very simple strategy, buying on a bounce back, basically. We waited for a first bullish swing, then we waited for another pullback confirmation. We entered the market long on the pullback. We computed the position size according to the risk management we've set up earlier. And then we defined some meaningful targets from a technical standpoint. And that's a good trade. So now we're going to talk about the tactics that may differ from one traders to another. Because, for example, maybe a very aggressive traders would have opened a big position here and then close it all on the first, you know, resistance on the first target. A more, let's say, swing traders would have kept the trading alive until that point, but maybe closing partially at each level. It's all up to you, guys. There is no magic setups or, you know, right answers again. You have to define it for yourself and stick to it. Okay. But this is how traders do, because basically we identify a trend, potential strategies, we enter the market at a, you know, meaningful level, computed the position size, define some objectives, many objectives, actually, many targets, and that's it. That's it. This is how it's done, basically, right? So yeah, let me go back to the slides. I just have some final words for you guys. And then we can switch back to the questions. So let me share the screen. I stopped the sharing. Okay, okay, that's it. All right, should be able to see it now. All right, okay. So basically, what I wanted to tell you is, you want to look at the dark side. Again, no fatal mistakes. These are some key takeaways for you to take with you. So first, no real stop or a symbolic stop. A stop that's too wide, placed randomly, or worse, no stop at all. That's the fastest way to let a trade spiral out of control and end up with a huge loss because it will come back eventually. The market will always be right longer than you can be solvable. You know what I mean? Then you can have money. Don't forget that. Second, position size driven by greed. All right. Don't make that mistake, folks. Honestly, this is very important. You see, a perfect setup, you crank up the size, then you place a stop way too tight just to make the math work. That's the opposite of what we just saw. Okay. It's risk second, ego first, and it doesn't end well. All right. Three, taking a lot of trades on fuzzy setups, changing method every week. One day it's breakouts, the next day is going to be ranges, the week after it's indicators, results, no edge, no usable statistics, and just a messy trade history. Stick to your strategies, guys. All right. Four, ignoring transaction cost, spreads, commission, slippage. If you scalp with tiny targets and don't factor in costs or commissions, the broker is going to win. Okay, you don't want to overtrade. You want to factor, especially if you're trading with the M1 or M5 chart, right? A serious plan always integrates this cost into the sizing and target calculations. Don't forget that. Five, over trading after a losing streak, blowing through daily loss limits. I've seen many people doing that actually. This is the classic, I'm going to make it back, if you know what I mean. You double the size, you force setups, and red day becomes a red week. It's okay to have a red day. Okay, no one can be right 30 days in a row. Even professional traders, trading on a trading floor, they're not right all the time, right? It's okay, but don't let a red day becomes a red week. Never do this, right? Your plan must include a maximum daily/weekly loss, after which you stop trading. Simple as that, right? If you avoid just these five, you've already give your trading plan a real chance of working over the long term. All right. And finally, some key hints about routine and discipline for trading success. This is the last building block. Honestly, it's all going to be about routine. A good trading plan without routine is like a workout program you will never follow. All right, we'll divide this into 4 key moments. One, pre-session. For example, 10 minutes of preparation, right? Before you open a single ticket, you spend 10 minutes to mark key levels on your chart. So supports, resistances, liquidity zones, whatever, okay? Define a market bias, bullish, bearish, neutral. Check the economic calendar always, so you don't get surprised by major news unless you deliberately trade them. The goal here is to know what you expect from the market before it starts moving. Okay, it's always good to have a little preparation. 2, during the session, execution checklist. All right, you don't click because it looks good. You run through a checklist. Is the setup in line with the plan? Is there a clear technical stop? Is the minimum R multiple respected? Has the position size been calculated? Anyway, and so on. If any of these is no, the trade, you may want to prefer to make the trade just don't exist, for example. This is how you keep ego and FOMO at a distance, all right? You want to get away from emotions when trading, all right? And 3, post-trade quick journaling. This is crucial, guys, okay? I see many traders don't take the time to do that. After each trade you take, You may want to take 2 screenshots before, after. You write down 3 lessons, what was good, what was bad, what you will improve on the next trade, blah, blah, blah. All right. It shouldn't take more than a few minutes. But if it's what turns a simple loss into useful information, then you've won already. For weekly review, once a week, you step back and review your win rates, your average risk reward, your performance in R, and you pick one single improvement focus for the coming week, for example, right? You always want to take your trading to the next level. This is the goal. The goal is not to be perfect, guys. The goal is to be slightly better every week, every day, every week. More disciplined, more consistent, more emotionally aware. In the end, this one-page protocol, profile setups, risk management, exit tactics, mistake to avoid, and routine is your battle plan. It's not a guarantee of profit. There's no guarantee of profits on the financial markets. Honestly, it's full of risk. You have to bear that in mind, but you have to come prepared. Okay, this is what separates random trading from a professional process. All right, this is what I've been trying to teach you guys throughout those sessions. Okay, I think I've come to the end of not only this session, but this whole 7-part live webinar series. It's been a very pleasant journey with you guys. I was very happy to have it with you. Please, if you have any question, Ross, just let me know if there's any question. We're gonna take the time to respond to everyone, and then we will wrap this up.
Okay, yeah, thanks, Pierre. Yeah, there is a question. So it's around your stop losses. Someone's asked, how far should you place a stop loss on a limit order? I saw what you said there with the Fibonacci. Do you use that as well for the Fibonacci part? That's the question.
No. For the stop loss, no. Fibonacci can be useful for identify targets or potential bounce back zones, but it's I mean when it comes to trading execution, so limits, orders, stop and limit orders, stop losses, for example,
Yeah.
there are no magical answers. All right, it all depends on. I mean, it has to be technical. It has to be technically meaningful. This is the only answer I can give you. But I cannot tell you 10 points, 15 points. It all gonna depends on the market, the underlying volatility. It has to be above or beyond some technical points. Last top, last bottom, some moving average, some trend lines, some chart patterns, whatever. It has to be above or beyond, depending if it's a long or short position. But apart from that, I cannot tell you how much. It's going to depend on the market. It's going to depend on your risk appetite. It's going to depend on a bunch of factors. So I cannot give you any advice here, unfortunately.
Okay. There's another question. Entry zone in our trade was wick of red candle near the support level, and that's all they put.
On my example,
yeah,
the entry
on
zone.
yours.
Okay.
Was it on the
The entry
wick of the
zone.
red candle? Was it on the wick of the red candle?
Oh, okay. Can you see the chart I'm sharing right now, Ross? Maybe I
No,
can.
can't see it. Just share the chart again, because we
Oh,
still got
yeah. I need
the.
to. I need to. Okay. Let me switch quickly to the chart. All right. You should be able to see it now. Okay.
Yes.
So on this example, let me go back to it. Right. It was actually here. So it was at the on the week actually. Yeah, it was on the week
Yeah.
of the candle. But
Okay.
basically, I just defined a support area right here, the
Yeah.
green line, and then a support zone. I don't know if you can see the box right there.
Yeah. Can see it.
Okay. And I wanted to, in this example, again, it's not going to be the same process every time, but in this example, I was looking to go long when the market goes inside that level. So any price inside that box would have been fine, actually.
Okay. Gotcha. All right. Yeah. There's a question about the markets, just in general.
Oh,
Someone asking, markets have been hitting higher highs recently. Do you think this is going to continue? I know you can't really offer advice or anything on this, but your own personal standing, what do you think?
All right. So of course, we're not going to give any advice here, but statistically, okay, I have an answer in two parts. All right. I'm just going to try to not make it too long, but statistically speaking, when the market registers new historical highs, like for example on the Nasdaq or S&P 500, that's I assume this person was asking about indices. All right. Um, statistically speaking, when a market register new historical highs, is going to continue registering new historical highs for some time. But, guys, and I cannot stress this enough, we're living in very uncertain time at the moment. First of all, we're getting close to the end of the year, when you will be able to notice a bunch of different erratic moves, as traders may push the market in one direction or another, uh, because the year is closing soon. Second, especially on US indices, we're getting out of a shutdown in the US, which brought a lot of volatility and uncertainty, because now a batch of economic news that hasn't been published during the shutdown is going to be disclosed to as public information, and investors honestly don't know what's going to happen. And actually, you can see that already on US indices. We almost registered a new historical high, and then the market plunged. So that's especially true on the Nasdaq and S&P 500. We're going into the earnings season as well. We have Nvidia actually today about to speak or has spoken already.
Okay.
A lot of uncertainty, not to mention what's happening in the Middle East and Eastern Europe. The monetary uncertainty as well. We don't know if there's going to be more rate cuts. I mean, in the Eurozone, in the UK, in the US. So it's very, very hard to tell you that the market is gonna register a new high before the end of the year. Honestly, especially when I see what I can tell you for sure is that volatility is significantly rising. Look at what's happening on the Nasdaq at the moment. Look at
Yes.
this on a daily, no, H4. Look at this new historical high, and look at those drops. It's hard, and this is the sign that uncertainty is rising. And I don't think anyone knows what's going to happen for the market in the coming weeks. The AI bubble may blow up. Anything can happen. So unfortunately, I know I'm a market analyst, but I cannot tell you if the market is going to go back there or keep falling before December. We'll see.
Okay. Very interesting. Okay. Yeah, thank you very much, Pierre. No other questions. So yeah.
Well, thank you so much, guys. It's been a
Appreciate
pleasure.
everything you've done on it with all these seven seminars.
It's been a pleasure. Well, it's the end of our 7-part live webinar series, but please feel free to reach out to Ross or myself if you have any questions about the markets, about those webinars, about GMG as a broker. We'll be happy to help you start your trading journey with us, guys. So feel free to reach out, email, phone, anything. We'll be here for you.
Oh, one more question. Sorry, one's just
okay.
popped in. In our example, was it change of polarity, resistance becomes support?
Absolutely, yes. Someone has paid attention. Exactly. We had we had a resistance level that kept the market trading below. Now playing the part of a support level. So this is a change of polarity. Exactly. And it's often the case, when you have a support level and the market breaks it, then it becomes most of the time a resistance level to the market. Actually, when the market is going higher, the market has a tendency to pull back to the previous resistance level because it wants to test the newly established support area, right? But you were right, that was a change of polarity. So I commend you for that.
All good. Okay. Thanks very much. Thanks, Pierre.
Thank you so much, guys. Have
Thanks
a great
everyone
evening.
for attending.
Good to you all. Cheers.
Thank you. Bye-bye.
Bye.